One of the ways of taking advantage of this small cap premium is to look at equally weighting. This is one of the earliest approaches to this, where instead of investing in each company in proportion to how much they make up of the index, you buy the same amount of BHP as you do of Computershare, as you do of Origin. And so that skews your average market cap to the smaller end of the market. VanEck have an equal weighted index in Australia that a market cap weight index gives you. It's harder to hedge because people don't want to hedge equal weighted. So it takes a bit more work to manage. Therefore, your costs go up. You have higher trading turnover, which leads to higher taxes. I think the jury's still out on that in an Australian context. I've seen it work better offshore, but clearly with the dominance of Magnificent Seven, that is those big 7 tech stocks, over the past 5 years, very few of these strategies have worked, notwithstanding the academic evidence that says they should work over the long time. And that's where this recency bias becomes a problem, that if investors focus on the last 5 years, they'll go, that strategy doesn't work, therefore the funds don't succeed, and nobody's interested in launching new ones. So it is a challenge, but the 5-factor model has a long history and a lot of academic rigor in getting to that. Implementing it is a bit more of a challenge, that it's very easy and cheap to run a S&P 500 or an MSCI World or an ASX 200 fund. And that becomes attractive to internet commentators who see the low price. And these indexes become de facto the market, even though they're not actually the real market. The S&P 500 has become the benchmark by which we measure the US market. But it's not actually the market because it only includes 500 companies who may or may not be the top 500 at any one time. That doesn't make it bad. It just means that you've got to be careful when you say you can't beat the market. It doesn't actually take that much to perform an index if you are prepared to accept tracking error. And Dimensional does a little bit of this work on their indexes. We've all become fund managers since the government introduced compulsory super in 1993. And so every one of us is managing a portfolio that is going to pay for our retirement, and we are taking responsibility for its returns. And many people are turning to the stock market as an alternative to buying a home. So we are becoming more and more a world and a nation of share owners, even if we don't really think about that. But the internet now has certainly made that much more convenient. It's certainly much cheaper than it used to be.